Okay, Cale again here. Let's walk briefly through our U.S. market outlook. The first few slides here are a couple of different versions of slides making the same point basically, which is that market valuations in the U.S. are generally high outside the energy sector. Here's a couple of 5-year and 1-year valuation levels. The top slide shows, this is right out of Morningstar, by the way, where we are currently versus historically in terms of overall levels of market valuation. The red above the line there being periods where the market is being overvalued, below the line being temporarily undervalued. The bottom call out section of that screen is really just on a year-over-year basis. So I thought it was interesting that you can kind of point to that as possibly explaining some of the sell-off earlier this year. Arguably the market was significantly overvalued coming into 2018, not dangerously so, but to a significant statistical degree. And as we saw that sell-off happen earlier this year, you could see it revert to that mean fairly quickly. So valuations, they do matter, and to some extent drive some of those longer-term moves in markets for sure. Here's a shot S&P 500 valuation since 2003. Just a different way to tell you that nearly all valuation measures suggest that the stock market in the U.S. anyways is expensive at the moment. It shouldn't be unexpected though, right? This is the 9th year of a bull market cycle. And the good news is that we've had some really strong growth in fundamentals like sales and earnings, and that have kept these valuation measures from rising even higher. The Shiller PE, it's named after Robert Shiller up in Yale. It's based on essentially 10 years of inflation-adjusted earnings, making it a pretty powerful long-term valuation measure. That said, it does there is a sort of an inherent upward bias to it the last couple decades, which is sort of a whole other discussion. But the point is that this also suggests that the market is expensive, although not yet in bubble territory. So this too is consistent with many other valuation measures of the market, the U.S. market specifically, at this moment. S&P 500 earnings per share. The growth in corporate earnings has been a significant driver of stock market returns over this particular market cycle. Those earnings have risen over 100%, all of which is very good news. Corporations have, on balance, boosted their profitability by cutting costs, financing themselves with low interest rates, and frankly, just getting more efficient. You do see a little wobble on this chart. Earnings did take a tumble from 2014 to 2016, really due to falling oil prices and the rising U.S. dollar, but you can see they've recovered since then. So just a reminder, I guess, to sort of summarize the last couple slides. The market it's a discounting machine. A lot of the earnings good news is really essentially already priced into stocks. Sort of a lot going on in this table here, but I think that the relevant takeaway is after periods of high earnings growth, as you might expect, valuations increase to reflect those superior earnings. But the flip side of that is, as you look forward, your expected returns diminish, right? Higher valuations to start with means you're going to, on balance, see less gain after the fact. So sort of a busy way to summarize all that, but again, the market is fundamentally it's a discounting machine. So I would not necessarily expect this year in the broader market to resemble last year in really any way, shape, or form. But we will see. Stock market volatility has begun to increase in 2018. It really ended a long period of extreme calm in the stock market. So I think in 2017, last year, people maybe got a little complacent in terms of normalizing around a level of volatility that was unsustainably low. While volatility often does stay low for long periods like that, those sorts of episodes, they're almost always interrupted by some sort of macroeconomic shock. That said, volatility is a normal part of investing. I think it's important just to stay disciplined, look past that short-term market turbulence, and let's stay focused on the longer term and frankly, more meaningful things other than the sort of daily, weekly ups and downs. felt like this was a good shot here. Underscores, while the overall market isn't really no longer cheap, there are opportunities within specific sectors. That tall green bar on the left is the energy sector. It's, I think, consistent with the idea that we should, because we're focused in Tarpon specifically in the U.S. market, we should, on balance, do much better than the broader market. Strong earnings growth, again, it's benefited most of these sectors. Most on here, at least according to the street, are still expected to see double-digit gains. Energy should be a further exception to that rule, if you will. And really on this, only real estate earnings are projected to be negative, really as a function of rising rates, essentially. So for those of you here who have sort of broader, more diversified private accounts, this is behind Retz and I spending some time on looking and finding some things that might be substitutes for REITs in your portfolios, like we have been the last few months. This sort of thing might sort of superficially explain why we're making those substitutions for what's that's worth. I do think it's important to sort of keep an eye on, and rather than try to predict or project the business cycle, just sort of knowing where we are in general in it. The current economic recovery that we are in it's the slowest on record. This chart shows cumulative GDP growth over each of the past cycle. The numbers on the horizontal axis at the bottom, by the way, are months, in case that's not clear either. The silver lining to this current recovery, though, is that the growth, it has actually been steady. So it's resulted in one of the longest business cycles of the last 200 years. So the slope of that line of the current cycle is not as pronounced or as high as some of past cycles, but the good news is it has been longer than the others too. There's many factors that have contributed to that slower growth, including demographic trends. Sort of a whole other discussion, but I think the bottom line is, as investors, at least in U.S. markets, you should probably expect growth of around 2% going forward. So not a huge step up or change from the past few years there. Economic growth has also been steady this cycle. It's averaging about 2.2% on a quarterly basis, that is. Again, that recovery has been slower than past cycles. Growth just never really has accelerated as many had hoped. There's a couple of reasons for that, including, again, just sort of general demographic trends. The severity of the financial crisis, to me, is still a big driver of that, and slow productivity growth. Too many people on Facebook or something. I don't know. I'm just guessing. Unemployment has fallen significantly during this economic expansion. It is now below its long-run average and is near what economists call full employment. That low unemployment does suggest that we are, now later in this particular business cycle. It's rare for unemployment to fall below that 4% level, and that it's a little bit of a misdirection, I guess, or inaccurate is probably a better word. Because it doesn't necessarily capture the fact that many who have left the labor force have just had difficulty returning, on the terms that they'd hoped for. Got people working part-time, they'd rather work full-time, maybe had to take a gig in something they weren't necessarily educated at college in, that sort of thing. But there's no denying that the record number of job openings does suggest that the economy does continue to improve. Okay, I'm going to shift a little bit. Things that we are watching closely. It's a little too, I think, dramatic to just call these risks. Some of them are, but none of them are what I would say anything we're urgently concerned about. It's more just things we're keeping an eye on. This is sort of our annual reminder of how sensitive bonds are to interest rate rises. This is a pretty good graph showing interest rates have been on a declining trend since the 70s. It's been a 36-year bull market for bonds. That bull market is effectively over. Interest rates have been at historic lows since 2009, and they were actually in many parts of the world short-term rates in negative territory in the last 7-8 years as well. With the Fed now raising short-term interest rates and U.S. economic growth steady, long-term interest rates should slowly climb higher from here. U.S. trade balance. It's been in the headlines lately for a few reasons. Big picture, the U.S. trade deficit has expanded in recent years. In 2017, the U.S. ran a trade deficit over $500 billion with across most of our major trading partners. This has become a fairly politicized topic here in the U.S. as many workers really face the effects of automation and globalization on their own livelihoods. Unfortunately, these are really sort of long-term forces that are, in my mind, unlikely to be changed through sort of one-off trade policies. The administration has proposed trade tariffs in an attempt to protect domestic industries. Nothing is set in stone yet. These are just proposals at this point. The markets are arguably nervous that this might result in trade wars and therefore harm global economic growth. But let's see what happens. Nothing material, at least in the last few months, has been solidified. So again, just something I don't believe is immediately actionable in any way. Just something we are keeping an eye on. So sort of a busy slide. I wasn't quite sure how to correctly capture it. The point of this, though, is there have been some what I'm calling just unhealthy codependencies. And that's not even my term, actually. That was a great study that I read that sort of pulled all this from. There's clearly a strong correlation between some of the big tech stocks, your more passive investment strategies that have gotten popular the last few years as this bull market has continued, and just the rise of computerized trading, a lot of which is sort of momentum-based. The point of this slide is really that a lot of people don't quite grasp that right now there are just 8 tech stocks. You've got the FANG stocks, if you will, plus Microsoft and NVIDIA that account for 15% of the entire S&P 500 index. S&P 500 is a market cap weighted index. So you've got 8 out of 500 companies that account for 15%. And even more surprisingly, those same 8 tech stocks account for 48% of the NASDAQ 100. I think this is interesting. I'm not quite sure how important it is yet. It is, I think, possible to spin this into a potentially bearish outcome in that, for instance, if there were some sort of global shock to the financial system or a war, that, it would ostensibly be pretty easy for a lot of people to immediately sell off big chunks of the market in these ETFs that are very overweight tech stocks. For now, again, just something we're keeping an eye on. Frankly, I don't quite believe that most people realize that investing in the S&P 500 index these days, it may not be as diversified to the extent you think it is. There is an unusual concentration of capital in 8 tech stocks right now, and read into that what you may for the time being. On the federal budget deficit, also in the back of our minds, to be clear, the recently passed tax reform, it is a positive, at least for financial markets. I did a whole slideshow on those changes and the good, bad associated with that a month or two ago. So there are clear positives in terms of financial markets in the near and medium term from that tax reform. However, there's also no denying that cost-benefit changes the further down the road that you look. The U.S. budget deficit adds over $500 billion to the total federal debt each year. The deficit has shrunk as the economy has improved the last 9 years, but still we are far away from a balanced budget, let alone a surplus. I think that's really most relevant because of this. At some point in the not too distant future, call it 7-10 years, ostensibly or hopefully maybe even earlier than that, we, I think as a country, got to ask ourselves, okay, does debt matter? I thought this was a great slide basically showing that within 7 years, U.S. net interest expense will exceed spending on everything else in the U.S. government budget, which I don't believe is really widely known at all, and certainly jumped out at me. What does that mean for us today? Well, stepping back, big picture, when you think about it, U.S. government debt, those levels, they're really a result of being unable to control or predict accurately economic growth in this country, right? Really from day one. It's just a direct function there. And so I personally feel like, the way to start addressing it, the answer isn't necessarily trying harder to control or predict our economic growth, but really to build a margin of safety. Now, in terms of what that means today, well, among other things, that means there is a lot more pressure on the Fed to engineer a soft landing for us as we still continue to come out of the Great Recession in 08 and 09. Again, not anything that's immediately actionable. It's certainly in the back of my head. I think it's going to become, whether we want it to or not, more of an issue as we get closer to, say, the 2025 deadline. A lot can happen between now and then, though, both fiscally and monetarily. So let's stay tuned and just be smart about how we're thinking about these things that are further down the road, but will be meaningful. So to summarize, here's a bulleted list. In general, I'd say the U.S. economy continues to look healthy. There are some legitimate market concerns, but generally speaking, this is still a good time to be invested. Though Retz and I do think that being selective about where in the U.S. you want to be is a good idea. I'm obviously fairly biased towards the energy sector specifically right now, and much of that is an opportunity cost or valuation centric take on things. And also, as Retz was talking about before, if you don't have much international exposure in your total portfolio, it might be a good time to start thinking about that. Compared to international markets, especially the U.S. is overvalued. There are clearly some compelling opportunities overseas that don't exist in the U.S. right now because of this long bull market we've had. And that is it. Got one more section on new services coming up, but that's it on our U.S. market outlook for now. Thanks.